Good morning, and on this very rainy day, thank you for being with us. If it's Mumbai, it must be the markets. Particularly after this very insightful conversation with the former Finance Minister, Mr. Chidambaram, we will delve into some of the, that famous phrase, irrational exuberance as well, which maybe we are witnessing, maybe we are not. We'll find out from this stellar panel which I have with me today. Uh, but before that, I'd like to just explain some of the reasons why I am saying, what I do. So, till date, the BSE Sensex year to date has risen 12,700 odd points from the beginning of the year. The Nifty 50, 4,207 odd points. FII inflows are up 91,000 crore, and domestic investments have pumped in 3 lakh 17,000 plus crore since the beginning of the year. That's great news. Indian markets are really, hitting new highs. But equally, there are concerns. There are pockets where, regulators as well have sort of flagged off concerns. I'll start with Manish, veteran of the markets. Manish, benchmark indices are hovering at record highs on a daily basis. Uh, being a market veteran, how do you see this current rally, and do you see any red flags? I mean, we'll start with that and then we'll go into specific areas.
Uh, Thanks, Saurabh. The fact that you're asking about red flags means that the market is cautious.
That's
And
right.
indeed, everyone on the panel will share that. But if I take a minute to just give some historical context, since the 70s, when we broke the gold standard, money gushes into some market every decade. In the 70s, you made a big top in the then Nifty of the USA, the Kodaks and the Xeroxes and the Disneys and so on. And then they crashed. By the end of that decade, it went to commodities like gold and silver and so on. By the end of the 80s, it went to emerging markets, which was Japan, Taiwan, and so on. In the 90s, it went back to NASDAQ and technology. 2000 to 2010, we had the era of BRICS and commodities, and really was the peak of China. Again, in the last decade, 2010 to 2020, you got the cycle back going to technology. So all the events suggested that India would be the epicenter in this decade. Because of our demographics, because of what's happening in the Western economies, which are all now ex-growth, also because of what China did its own self-goal, one expected this to happen. The domestic flows, which the young Indian finally earning has adopted thanks to the stellar work done by the mutual fund industry of Mutual Fund Sahi Hai, has brought them into the market through the systematic investment plan. And that's created a base for the market, which ordinarily you would expect if earnings grow every year, your market would grow every year. And the market, unlike a fixed income security, will always hover above or below what should be the regular level. So perhaps for the mainline indices, we are discounting a bit ahead, maybe 1 year ahead. The red flags, which you rightly point out, have really occurred in what I call quadrant 4 of the market, because 75% of market cap is really sitting in the large caps, which are over 50,000 crores. It's only in quartile 4, which are the small companies, where naturally there's exuberance because 1 or 2% of the buying is ending up lifting those prices. And the absolute red flag, of course, is in the SME exchange, where
We'll come to all of that, yes.
we were speaking earlier about things like that. So, but the fact is, a market doesn't make a top on the basis of excesses in quadrant 4. So I still think it has legs to run. And the foreign inflows which we are expecting have still not come of the magnitude that they should have. And I still think that lies ahead of us.
Radhika, I mean, the domestic institutions, including yours and the domestic mutual funds, have done a stellar job in terms of sort of stabilizing the markets in the absence of foreign inflows to the extent we hope they would have. What is your sense about where the markets are? Do you think it is getting overheated? The topic of the session is how are Achche Din continuing, or are Achche Din going to be behind us very soon? We'll come to what the investors need to do a little later, of course.
Yeah, so let me start with domestic flows. And Every month our industry publishes a monthly SIP number, and it used to be, when I joined this industry, which was not that long ago, it used to be 4,000 crores a month. That was in 2017. Now it's about 23,000 crores a month. And every time that number comes out, the media looks at us with some kind of skepticism. कि ये हो क्या रहा है? How is this happening? And I don't understand that skepticism, because I genuinely think our industry has done a lot of good work, but a rising SIP book and financialization is deeply structural. If you look at the US economy, when US GDP went from 4 trillion to 10 trillion, which is about 2.5 times, their mutual fund industry went up 20 times. Now do all your math. I think a rising SIP book and rising domestic flows represent a changing risk appetite of young India. And that reflects in the, and I still consider myself at 40 somewhat young, I think it reflects in the fact that 50 years ago, young India wanted to do a permanent job. Today, they want to do a startup. Today, young India signs up for Coldplay tickets and stands in iPhone lines. 50 years ago, it wanted to do a recurring deposit as its first investment. Today, it wants to do an SIP. So I think domestic flows are not magic. They are structural. They are problems and segments that we can talk about, but it is structural. So every month when this number rises, I don't think anyone should feel surprised. Now on overheating, I think Manish said it well. When people look at India, when we look at India for 5 to 10 years, we see tremendous optimism. We think Achche din will last. We see growth with stability. We see an environment of reforms where entrepreneurs can build. And we see incredible demographics that China saw maybe 15 years ago. So in 5 to 10 years, I think we see a lot of excitement. I have never seen a bull market in any country which doesn't have pockets of exuberance. And I think there are two kinds of exuberance today. There's one which is reasonably good sectors trading at 80 to 100 multiples because the market is giving you a premium for growth. And then there's people running Yamaha showrooms and getting crazy multiples. So there are two kinds of, there's good exuberance and bad exuberance. But every bull market has a share of exuberance. But if you ask me, for the broad part, is this here to stay? I would say certainly.
Navneet, you are with you're the boss of Amphi. You have a sort of bird's eye view of what's going on in the mutual fund industry, and of course therefore the markets. Would you agree broadly with what Radhika has talked about in terms of the domestic inflows and how the broader markets are still looking very, very good?
Of course, so mutual fund sahi hai. We all strongly believe in it. My grandfather lived in an era where the country had to import wheat under PL 480, which was a leftover of United States. My father lived in an era where foreign grant was still very critical for the well-being of Indians. I lived in an era where Indian entrepreneurs were overly dependent on global money, be it an venture capital or a private equity or public markets. Ownership of public market was like 25% held by foreigners. My kids are living in an era where a Hyundai or an LG and maybe tomorrow many other global investors will be raising money from this country, and we are raising money from SIP, which is 2300 rupee ticket size per account, 10 crore accounts, 23,000 crore rupees. What a transformation that we have seen. This is the power of the retail money. I agree with both of them. These are early days of financialization of savings in India. The formalization of the economy, digitalization of the economy, and particularly digitalization of finance and financialization of savings. These are structural long-term trends. And of course, the other one I can add is financialization of assets, that even whether it's infrastructure assets, real estate or variety of these will also get fractionalized ownership, and larger number of Indians will own that. This is a structural trend. I'll just give you one data point. 23,000 crores into 12 is almost $35 billion. Manish has been in market for as long as maybe a few years more. There has not been a single calendar year or a financial year where foreign portfolio investors have invested that kind of money. And this is coming from retail individual investors in India. I think we must not underestimate the power of it. Markets move like pendulum. They will do excesses on both sides. I agree with Manish. There are parts of market, SMEs, some of the IPOs where I think investors think this is not an initial public offer. They think this is instant profit opportunity. IPO means instant profit
That's a good one.
opportunity. SME is like a short-term money making opportunity. These are not like that. Trees don't grow to sky. So some of them will correct. That's the nature of the beast. But overall, I think if you ask me about India's fundamentals, I think we are creating an economic miracle which is unparalleled in human history, and we can discuss more about it.
Saurabh,
You know,
may we take a second?
yes, yes, please.
On a $5 trillion on a market cap of 5 trillion, half of it is owned by promoters, whether it's Indian promoters or government, and some more with multinationals. And about 15% is owned by foreign investors. So 65% is not with the Indian retail. So 35%, let's say, is 1.5 or thereabout trillion dollars is held by Indian public. That they've made money for the first time in the last 20, 30 years in size is just so pleasing. Having said that, we never question that we still have more than $2 trillion worth of gold held by the Indian households. And we probably import, what, $70 billion of gold every year. And we are worrying about 40 billion coming into equities. So the asset allocation mix is a big change which has to happen. What he was talking of earlier generations holding on to gold, the young generation doesn't want gold. They want to hold equities because that's a rising cash flow stream. So you can have years of excess and decline, but eventually the companies will create wealth. And as long as you're on the right horse at a decent valuation, I think this story has a lot of legs to go.
But Manish, you have also expressed concern that more and more of assets have, I mean, money has to come into equities because still there's a lot more in other assets like gold and real estate. So that's the optimism. Now, you know, Navneet has spoken very rightly about the retail part of it. But you have also raised some concerns about the top quartile. I mean, there's too much of concentration of market cap at the top end. You know, and how does one sort of ameliorate that? Because that will again add to the volatility in the markets. If too much money is chasing too few stocks, how does one rectify that? What about new supply of money, supply of stocks?
So you have a number of questions. So first, let me just give you the stat. On a $5 trillion market cap, 11 companies are 25% of that. The next 31 companies are the next 25%. So 42 companies are half of India's market cap. There's no excesses in a way over there. At best, it's 1 year ahead in terms of earnings. The next 87 are the third quartile. So around 130 companies and 75% of India is done.
But is that a good thing?
It is, because in the past, if you had asked me, this would have been 7 companies instead of 11 in the top 11. And maybe 30 companies would have been 50%. So it is broadening, and this money which therefore has been coming into mutual funds and giving more and more capital to entrepreneurs to come in is broad-basing the market. But having said that, the nature of capitalism is most industries will tend to consolidate, like you'll have 2 or 2.5 airlines or 2 or 2.5 telecom companies, 2.5 port operators and so on. It's the nature of capitalism. Even in the US, when you talk of the Magnificent Seven, which are what are driving the markets over there, it is to be expected. The fun of India is that there are just so many businesses that you can find over here, unlike other markets where they are largely property and finance companies. In India, you can go sector after sector after sector, and you find leadership companies there. Some of the mid caps of today will become large caps of tomorrow because the sectors themselves are slated to grow. And again, for context, in the world where we are still at a 4 trillion market cap, GDP, sorry, if you take the next 10, 20 years, which is our demographic period of excess growth, where does this economy go in the next 20 years? When PM talks of Viksit Bharat and developed India in 20, 25 years, it's really demographic trends which will get you there. It is entrepreneurial trends which will get you there. And juxtapose that with this amount of capital which is now available, which historically we had to look outside India, which is now available to entrepreneurs here. I don't think anyone cannot do a business today for want of money. The problem he may have is excess competition, or he may not get a valuation he or she likes. but there's no shortage of capital for people with dreams now. So in that context, I think we're still on a good wicket.
Radhika, your thoughts on concentration of market cap at the top end and whether that is going to change going forward?
So, two things. I would say the universe of listed companies is going to expand. Today, you have about 500 companies that are billion-dollar plus market cap. And I think India has had a very vibrant IPO market for the last couple of years. And I believe that we will have an extremely vibrant IPO market for the next few years. So much private capital has come into building some very high quality companies in the last decade. And these companies have become large enough that now public markets are the only way to get them to exit. I mean, to put it into perspective, India's largest exchange is still an unlisted company, and hopefully one day will be a listed company. So I do think our unlisted market, you will see a major migration from unlisted to listed. And I think one of the good things that has happened over the last year in the listed markets is some of the new business models, through their ups and downs, have seen testing and maturity. So in 2021, you had Zomato, Paytm, many of these companies list, and it's been up and down in the capital market. And there was a lot of cynicism about new age companies listing. 3 years later, I think many people have learned the lesson. The market has learned its lessons. And you're seeing new age companies in this round of listing being met with a lot of enthusiasm and sustainability. People are talking profitability. People are talking the language of listed markets. So you have listed companies. I think the listed universe will expand meaningfully. I also think a lot of commentary is made on mid and small cap, especially mid and small cap valuations, etc. Let me go back to some data. So I was looking at data from 2000, and the average market cap of a small cap company in 2000 was less than 100 crores. The average market cap of a large cap company back in 2000 at the turn of a millennium was about 3,000-4,000 crores. Today, and I'll have my numbers wrong because markets have rallied since I've seen these numbers, the average size of a small cap company is 13,000-14,000 crores. So our mid and small cap companies, while you call them mid and small cap, have expanded. You have market leaders present in the mid cap space. I mean, Navneet runs HDFC AMC. It's the largest listed asset manager. I think he still qualifies as a mid-cap company. And no one can tell me asset management is a segment I'm not bullish about. So I think our companies have gotten larger and that universe will also expand.
I'll just take you up on one point which you mentioned about more and more private companies coming into the markets, which is a very important trend which we are witnessing over the last maybe 1 year or 2 years now, or 3 years. Some of them have really not fared well at all, and therefore you said that they've learned their lesson, markets would have learned their lesson. You think there is, some realism settling in now in terms of both the valuations they expect and what the market can give them?
I think people are growing up. I see private companies all the way from Shark Tank to some of the large listed companies that we own. And I think in 2020, 2021, when you were in a zero interest rate environment, capital was very easy. And funding asked less questions because capital was just very easy. Today, the guys that have learnt their lesson are talking the language that a listed market investor wants to hear, which is focus on executing the story you're telling, which is eventual profitability, which is moving down from users to usage to revenue to EBITDA to profitability. And in every bull market, by the way, there will be good eggs and bad eggs. So just because there have been a couple of bad eggs in the listed market, I think there has been tremendous maturity between 2021 and 2024. Today, if you are a high growth company with sensible unit economics, you will have a chase of capital. So actually capital is concentrated in few high quality private business models. And if you don't have your unit economics orientation, you will struggle to raise capital for the large part.
Navneet, you spoke about retail investors and the manner in which they've come into mutual funds as well. Now, retail investors from say post-COVID and during COVID also, when huge money was coming into retail, number of new investors, first-time investors came in, rushed into the markets. They have constantly seen an uprising, in the markets. There is no real setback. God forbid there is one, but has been no real downturn in that sense, which we used to witness in the earlier days. Now, you think the new investors are getting too used to a market which is constantly on the up move, and therefore their expectations and preparations are not up to the mark?
So as a small kid, I started investing in early 80s, and Sensex would have been like 3 or 400. In the previous session, I heard things like, and it was kind of like, going down the memory lane or hearing words like Mandal Commission and 91 and many things, the coalition governments and all of that. Despite all of that, despite all the global geopolitics, the global economic cycle, the Indian economic cycle, political cycle, business cycle, profit cycle, I've seen Sensex going up from 400 to 85,000 now. In the next 40, 50 years, of course, it was a different era in terms of interest rates, inflation. But what it talks about is India is one of those few economies, few countries in the world which have grown nominal GDP at 10, 11%. You have a corporate sector which has converted that growth into their revenues and their profits. You have a vibrant and deep capital market which has converted that profit growth into the market return. And you have a mutual fund industry where even with 500 rupees you could participate in that. There will be ups and downs. Some of these investors haven't seen maybe a steep correction. Those who have come in last 2 or 3 years, maybe they will get their lessons. I mean, Manish keeps saying that you have to pay some tuition fee to the market. Some of them have paid. As SEBI's report has said that 93% people lose money in F&O. The percentage of money, is lost in intraday trading. So people know that they have to lose. But there is only one formula of wealth creation which last 40 years has taught me and will stand the time of whatever truth of time for next 40 years is STP. That's sound investment plus time plus patience. There is no other formula. That's the only one, and this is what mutual fund industry, all of us are working very hard. I heard a lot about distributional aspect of the economy, equality and equity. How do you get the best form of equality and equity in the country, where anybody sitting in a remote village of Bihar or Kashmir, they may not have the growth opportunities in their village, and if they cannot move out, they can put 500 rupees per month and can participate in the same growth story of India, which is happening in other parts of the country. So I remain very positive. I agree with everyone that this are very early days. Markets will have their ups and downs. All that I have talked about doesn't mean that market cannot fall in next 1 month and 3 months. Investors must be prepared for that. But I think the next several years, this is India's time. We are in Amrit Kal. We should not forget that.
In long term, Amrit Kal and bullishness definitely pervades the environment, Manish. But I wanted to ask you, your geopolitics, what they are, the global, the inflationary scenario, for instance, the geopolitical environment. What should investors do, in your opinion? What are the preparatory steps? I mean, there is no universal formula, obviously, but how do they guard, particularly for the new investors who have come in?
So that's the greatest question, because while we're all bullish on the long term, in the short run, if let's say something untoward happens and the market falls 20%, is the average new investor prepared for that? And the only way you can prepare for that is, number one, is your asset allocation okay? Because a lot of people in this euphoria have decided equity is the way to go, and they may well have put 80-90% of their money into some small cap. Because I'm very alarmed to see the largest volume traded shares in India and the largest shareholding. Regularly I see there are 3 stocks, and again nothing against them, they're fine businesses, is Idea, the telecom company, Yes Bank and Suzlon. 55 lakh shareholders in these companies, which is more than what, for example, would be there in Reliance or in even companies like Infosys or HDFC. So when things like this happen, people are going a bit off on terms of, number one, asset allocation. Number two, like I said, 75% of market wealth sits in large caps. But I suspect because of this last bull run, 75% of investor portfolios may be sitting in small caps. And in small caps, when a drawdown occurs, liquidity vanishes in an instant. Because remember, on a $5 trillion market cap, we are only bringing in 50 billion a year. So it's 1% is wagging the remaining 99%. And that sentiment can turn on a dime. So as long as you have some money on the side, you've not put too much money in the markets, if you're not only into the most speculative end of the market, and position sizing, where if you're individually holding stocks and one of them, for example, has become 30% of your portfolio and you're not conscious of it. So I think it's now not time for stock selection or equity allocation. It's more about what is the right mix of how you want to approach your investments. And for that, I'm still banking on the mutual fund industry to say mutual fund सही है वो तो हो गया, अब कैसे सही करना चाहिए अपने लिए वो आप सीखिए. I think it's that phase now.
Would you like to take that?
Yes, sahi hai. So, since we are coming up on lunchtime, and I'm an Indian woman, I have this phrase that has become a little popular. It is called dal chawal investing. And when I just try to summarize all the wisdom Manish said in the framework of a plate. When you have a plate, most Indians have grown up eating dal chawal or rasam rice or dal roti or some equivalent. And in Gujarat, you'll have a different dal, and in Chennai, you'll have a different dal, and in UP, where I come from, you'll have a different dal. I genuinely believe 80% of a customer's portfolio should be dal chawal products. Now, what is dal chawal? Dal chawal is stuff that is simple and sustainable and all weather and will make money over the long term. We represent the mutual fund industry. We have all kinds of products and we launch all kinds of products. We have plenty of dal chawal products. If an investor is investing in the top 250 companies of India in a passive fund, in an active fund, I am pretty sure over 10 years they will not lose money. And I don't think anyone on this panel will disagree. These are dal chawal investments. So 80% of your portfolio has to be oriented towards dal chawal, and your dal chawal can be tad bit different from my dal chawal. Unfortunately today, when I look at the flows that come into our industry in this year, about 60% of the flows have come into what I call pickle and chutney funds. So we are eating dessert, we are eating papad, we are eating pickle, and dal chawal is becoming a very small.
So there is a nutrition problem as well.
So we have a nutrition problem that will lead to diseases and indigestion. And if we orient back, so our advice to investors is always to veer towards the middle path, to hold and participate in the growth of India in the top 3, 4, 500 companies. And look, if you tell a young person to eat dal chawal 100% of the time, they will be bored. 20% of the time, you can go out to a restaurant and dine. But position sizing and 80% dal chawal will make money for a lot of people.
So 80% dal chawal, of course, will make money, as Radhika says, Navneet. But of late, like we've been discussing, the SME sector, I don't know whether that qualifies in the dal chawal segment completely, because we've seen a bike dealer, for instance, which came up with a 12 crore IPO, witnessing demand of 4,800 crore. Now, what is that if not a bubble? Please explain.
No, I think all of us agree that there are pockets of market. I think when you have a $5 trillion market cap, when you have seen the market, the way it has risen, the kind of liquidity it has come, it will create some collateral, I think, damage somewhere, and it will create some sort of bubbles in some pockets. But large part of the market, the largest companies that he talked about, the top 2 quadrant, you don't see that, right? So people have an ability to put good amount of money in high quality stocks for the long term, which are like large cap companies. There are some pockets where everybody wants to make money in the shortest possible time, but as we have learned over the years that instant gratification doesn't work, I think it's better to invest for the long run. And I think more and more people over a period of time will realize this. And sincere kudos to SEBI. My sincere compliments for coming out with some of these, hard-hitting facts and telling the investors that 93% of you are losing money. You can be very optimistic that I'm in that 7% and I'll play this market. And there is a section of market, and pardon me, it's not like demeaning for anyone. They think that investing is another form of entertainment. This is just another app along with some gaming app and maybe some of the other fun app. investing is a serious business. This is about long term. This is about fundamentals. You cannot like make money like this. People have got lucky in last few years, but we have seen this movie before.
Yeah, that's absolutely the point which I wanted to ask you also, Manish, about the F&O segment. Now, lots has been said, including the finance minister also saying, the government regulators are worried. SEBI has come out latest also, the 93% figure. But the other part is that, people still continue to invest. The same study says that a large part continues to reinvest and who continue to, get into the F&O segment despite warnings. Now, greed is good, as Gordon Gekko may have said, but life is not a movie. How do you look at that? And that can cause serious damage in terms of the stability of the markets, right?
Well, I mean, Warren Buffett said that derivatives are the instruments of mass destruction. So no one can express it better than that. But having said that, if you're a small timer who's just coming in, how do you create your capital? So the lure of I can go and I can buy a weekly product, I can make some money in the market and thereby build my capital is irresistible. So we can't wish it away. It does provide depth through the market because there are millions of people. And the same study mentioned that the amounts involved are 1 lakh rupee per head. And it's again, unfortunately, nature of capitalism that few will win and few will lose. It happens in the corporate sector as well. Maybe there were 30 telecom companies and now only 2 survive. Maybe there were 30 airline companies and only 2 survive. So I don't think a state can become a nanny state and legislate what you should or should not do. You can make the entry barriers better. So you come in with limited amount, at least certain amount of capital, like they have entry requirements for setting up a mutual fund and so on. So if as long as the guidelines are clear, enough warning signals are given, I think it's best left to the market. Because once you put in things like rent control, you will freeze the market as well. So that's sort of on one front. Secondly, this liquidity which we talk about in India is also benefiting from this F&O. Because the depth you get in certain stocks, if you were only trying to match a buyer and seller without the liquidity which is being provided by these day traders and algo traders and so on, you don't want to wish it away. So sometimes don't fix something with ain't broke. It needs repair and maintenance for sure, and the guidelines which they're talking of increasing the requirements to come in are right. But I'd be very cautious on just drastically changing the market structure or changing the dynamics to say one exchange can only do one product, the other can only do one product. Let the market do what it will do. Maybe just increase the barrier for people coming in and have better KYC norms over there.
I think there's a SEBI board meeting coming up where this
I mean, they're much more educated on this than I can ever be because I don't know derivatives. So let me not comment beyond my pay grade.
Radhika, you want to come in on the F&O bit?
I think India has to have a disclosure-based regime. We can't go back to the days of Competition Commission of India. So, every few years there's one of these things. A few years ago there was, should SEBI regulate the price at which IPOs are coming to market? SEBI can't regulate the price at which IPOs are coming to market. Should SEBI regulate F&Os? Yeah, it can do disclosure. It has done plenty of disclosure. Bar वो आपसे कह रहा है 90% of people are losing money. I mean, that is a pretty... If I was going to an amusement park and the sign said 90% of people will die on this ride, that's pretty stark disclosure. It's doing enough disclosure. It recently did disclosure on IPOs saying most people come into IPOs, don't get allotment, are there for a short period of time. So SEBI's job is not to curb valuations, to curb freedom of speech. SEBI can't curb influencers. If Manish wants to go and have an Instagram following of 5 million and say things, I know he doesn't, but if he does, and I think he'd do a good job at it, SEBI can't curb that. It's curbing disclosures to the extent it can. But the root of all this, and you all represent the media fraternity, is the root cause of all of this is impatience and a desire to make money in the short term. If we orient ourselves to think about investing with a long term, more purposeful orientation, if everyone in the press, instead of talking about 1 year returns, starts talking about 10-year returns, the root cause of all of this is the same.
That's a very important point. Yes, Nand.
I'll just make one point that rather than looking down on some of these things, the way we should look at it, the society is evolving where large number of people feel very optimistic. They feel that future is better. They want to create wealth. They have aspirations. This is the best sign that we have been waiting for a very long time. Now people are trying various methods. Ultimately, this is our belief. This is what we are working hard as an industry with, of course, the full support of regulator and government and policymakers and media people like you. The mutual fund sahi hai. This is the way to create wealth, remain disciplined, invest for the long term. But this is a good thing that larger and larger number of people want to take more risk with their money because they have aspirations, they want a better future for themselves.
I mean, would you rather have the young Indian believe that equity markets are an exciting place to be, or the young Indian believe that when I start working, I'm going to do an RD because stock market is speculative and yahan to kuch hone wala hai. We have seen that India. So what India would you prefer?
Manish, as we wind up, what would you advise a young new investor in terms of asset allocation? Given the fact that equities are moving up so dramatically, how is the portfolio likely to be balanced?
So I spoke about it briefly in the beginning that if you're young and all these wealth managers are more qualified to say it, that a youngster can take a lot more risk. So maybe instead of, like I said, $2 trillion in gold and only $1.5 trillion in equities is the wrong allocation. Surely your mix to equity should be higher. But within that, like she said, the dal chawal products, the large caps have to become 70-80% of your portfolio. And the tadka which you want to put, which is the mid and small, can be 20%. The caveat is in this era of T20 cricket where you want to make quick returns and grow your capital very quickly, remember if you get bowled out, there's no second chance. So if you will prevent yourself from being over-levered, having a wrong asset allocation mix which pushes you out of the market at precisely the time when it corrects, prepare yourself for a period mentally that what if this market falls 30%, how will I play? And if you think you have some cash reserves to play at the time when stocks become more attractive, that will give you longevity, because I cannot stop saying this more and more often. This market typically goes up 4 times in 10 years, which is a 15% CAGR, which is really the rate of return of most companies. And you can't beat that for long. In the next 20 years, if you do 4 times and then 4 times, the odds are you will be 16 times up. Let's say you don't do 16, you'll be 10 times more wealthy than you are today. And you're a young Indian. So just keep on that wicket and stay on the crease and don't get removed from the playing ground.
Navneet?
I think we discussed, I'll just take half a minute. A couple of years back, Saurav, on this whole debate of large versus mid and small, and I said the way world is changing, a time is coming where nimbleness and agility will trade at a premium to size and stability. We have seen that in last 3-4 years, but I think it's getting overextended now, and there are pockets where there's a lot of froth and investors need to get worried about that. But I strongly believe that the pace at which the world is changing, the people, I mean the managements and the leadership which is nimble and agile, regardless of the size, will trade at a premium to the guys who have size and stability.
So long-term bullish, Sensex hovering around 85,000. Manish, I'm told you are a very good singer. Bombay is where entertainment lives. Would you like to leave this audience with a song which is also, tells the message to the new investors?
I wasn't prepared for that, so let me take a second. So my favorite lyricist is Gulzar Saab.
Oh,
and,
lovely.
R.D. Burman. And he has a very lovely lyric which applies to our markets in the stage we are today, where you say your dreams are fragile and precious. So don't let them blind you. Hold them on your eyelids. And
Rose
you can
aankhon
hold
tale,
them
is it?
forever.
Rose aankhon tale, are we talking about? No, something else. Why don't you sing it for us?
कांच के ख्वाब हैं आँखों में चुभ जाएंगे आओ पलकों पे लेना इन्हें आँखों में रुक जाएंगे हो ये रात है ख्वाब की रात है फिर वही रात है
Superb, awesome,
Another
awesome.
bull market.
So you have the experts on the markets also leaving us with a song and some really sage advice. A very big hand for this stellar panel for sharing their thoughts with us today.